Hello, welcome back to Klever Stocks, the education wing. I'm your host, Kelvin. So, we will continue on the consumption data, the consumer data that usually we found on the economic data, or maybe the policy that helps, like the Federal Reserve policy to make decision whether they should increase the interest rate or they should reduce, or how, and also how does all this actually affect the whole stock market. So, in the previous education meeting, I've shared with you guys before on how the consumer, when they have more incomes and all this income, how can it go into a consumption, right? So, of course, there are discretionary incomes and also they have like disposable income. So, as we all know, discretionary income, okay, which is different from this disposable one, because by subtracting the necessary expenditure. So, for example, their net incomes, usually we need to pay for the essential product like rental or maybe mortgage or maybe a higher purchase, and also food and also all these beverages and daily expenditure or groceries, right? So, or maybe even insurance. Okay, so now we know that how this discretionary income and also disposable income is a gauge on this, because if let's say all this income is increased, which means that the economy is going to boom. So because more people more consumers are consuming the product, but when they are consuming more demand are created, so the inflation will come in because the price will keep on moving up higher, just like how this property market it is. If let's say there are a lot of demands and it's in a good location, and people will start to pay, rather wants to pay higher price to buy properties, right? So that actually increase the economy, and also the economy get to like overheat sometimes. So when it's overheat, then the Federal Reserve or maybe a central bank, they need to take certain adjustment for the interest rate or maybe for the stimulus plan to reduce, to make sure not to go too much bubble and avoid hyperinflation. So that's where they come in and like adjust the interest rate, or maybe like printing less money, okay, which we call it quantitative easing, okay. So these are things that it will actually see the whole economic cycle. So when you understand the whole economic cycle and plan ahead, knowing that the central bank is going to reduce the interest rate, then we might see that the stock market is going to move up higher. Why? Because there are more funds out into the market. For those like maybe for financial institution, they will have a lot of funds after selling the bonds, because if they reduce the interest rate, which means the bond price will actually start to increase because there are more demand out from that. So when we see that happen, they will pour the money into the stock market and push the stock price up higher. So that's why the recent correction in the global stock market is a good opportunity for you to look into it. Just like what Warren Buffett or maybe like Rockefeller, okay, who it was a businessman, okay, what they do is when everyone is panicking, they go into the market. So that's why you need to always remember there's no evergreen kind of stocks or portfolio. You should actually start to adjust or maybe like review your portfolio when you find that the economy is a bit overheating and you foresee that the Federal Reserve is going, or maybe a central bank is going to adjust the monetary policy, and you should start selling some of the stocks or those like high risk stocks. Let's say, for example, right now we do see like those tech stocks are flying up crazy before that, but when the correction comes in, they are the first one who collapse the most also. But it doesn't mean that this kind of industry you cannot continue to invest in. So since we know that it's going to have a correction, then we should sell some of our stocks, our portfolio, to cash out. So when we cash out, we have money in hand, then we can wait for opportunity. When everyone is panicked, that's where you start to move into the market, okay? So right now, since I'm talking about the high inflation, right? So of course, how this high inflation is going to negative impact on the income. So right now, for example, right now we can see that the inflation is high, right? So what should we expect from the next or the upcoming the monetary policy, and how should we play around with and also maximize our return for our investment portfolio? So very simple. Okay, you can see after pandemic, everything start to move back on track, and you can see businesses start to building up. So they are hiring a lot of people. So when they are hiring a lot of people, they want a professional or some experts, okay, from that area. So all these corporate, they will actually willing to pay higher salary to these expertise to join the company. So in that case, we do see there is an increase in income. But of course, this will actually transfer the cost into those corporate, which means that they need higher returns in order to cover the cost of their labor, or maybe for other, or maybe for their expansion, right? So that's where they have to mark up the price. So to the consumer, so when they sell the product or the service, they can make back the money. At the same time, they can pay all these experts. But when they start to see at some point, when the price is almost at the peak, then lesser consumption during that time, so we can see that the returns or the revenue start to slow down, then that's a signal, an alarm to tell all these corporate, okay, right now, in the market is unable to absorb this. Okay, so if the sales is going down, then they have to cut costs. So when they need to cut costs, before they cut costs, we can see the whole economy is in a high inflation because all the things are moving up. Like for example, you coffee oil last time probably like 250 or 2 ringgit before pandemic. Right after pandemic, it shoot up to 290. Okay, so it's like 90 cents of price increase. It's almost 1 ringgit increase there. So that's why we can see that there's a lot of the money that you have, that you earn, is not able to buy the same amount of product or maybe goods or services that you have bought before. Okay, so that's why these are the things that how this inflation is able to affect the real earnings. So if you look into this chart over here, we do see a nominal average weekly earning, okay, is going up higher and higher, but the real average weekly earning is going down lower and lower. So what is the difference here is that nominal, it doesn't include the inflation rate. Okay, so after you deduct all the inflation and also like a increase of cost, increase of prices that for the consumer side, consumer product, then you start to see what you are earning right now. Yes, overall, maybe last time you earning 10,000. So right now your price, okay, your salary, okay, increased to 15,000. But are you buying more product? Are you able to consume more out from your salary increment? Not really. So if you put it into the inflation, if let's say really high inflation, we can see that this whole orange graph over here is going down. So which means that yes, you getting more pay, but you are not buying more out from there. So these are the things that you can see that, oh, okay, currently the economy is in the high inflation. So when inflation is high, usually central bank, what would they do? They will increase the interest rate. Just like after the pandemic, we do see a lot of central bank are increasing their interest rate to fight this inflation, okay? Because they don't want to go into hyperinflation where you need to, push a truck of cash to groceries, and then you can only buy like maybe 1 egg or maybe 1 loaf of bread. So that will actually hurt a lot of the economy very badly. So that's why once we know that, okay, inflation is getting higher, so that's where we do see like, okay, we can foresee the central bank is going to increase the interest rate. So when it increases the interest rate, does it hurt the economy or does it hurt the stock market? Definitely. Because when interest rate is increased, those corporate or maybe private sectors, they have loans with the banks, right? So they can't say like, okay, right now we just pay off the loan and then we just don't want to pay for interest. So there are loans that are jacked up to 20 years or 30 years or even 10 years. So they need to allocate more money to pay the interest, right? So which means that if let's say the revenue is not increasing, then what should they do? They can slash their employee, right? So they go for retrenchment, they can go for cut down their headcount, so to allocate this money to pay the interest. Okay, so once we see this, which means that the profitability for most of these corporate or listed company will reduce. So when it will reduce, or some of the funds, okay, they are not going to invest into it, then we can see that the price of the stock will go down. So which means that when the real average weekly earnings shows that it's going down, people not having that much of money spent, okay, and boost the economy, that is the time, okay. We have to prepare. We might want to sell some of the stock first and keep some cash and wait for the market to crash. After crashing, going back to the the equilibrium price or maybe on the average price, or you can call it like intrinsic value, then you start to move back into it. Okay, so you always remember one thing is that the stock market, like what George Soros said, okay, the stock market is always not in a balance point. They are always trading based on expectation, whether it's always overpriced or maybe it's always undervalued. So when the expectation is high, then we have to be careful. Like for example, if let's say people saying that, oh, Tesla is a very good stock, okay, everyone talking about it, but you see that EV start to, yes, everyone is buying more EV, but the rate of growth for EV start to become stagnant right now. Okay, so we know that Tesla is not going to do well, and we do see that the consumption, okay, for the consumer spending is the real consumer spending power is getting lower. So we know that they can't afford Tesla, right? So we can just sell off Tesla, wait for it. For the next one, maybe for the AI related, okay, like NVIDIA or maybe data center, which I think like it could be the next industry that you will start to boom, because before all this AI are able to implement into all of our life, the first thing they need to do is they need to have the data center, the infrastructure, everything is done, then only AI is going to boom. Like for example, during the .com boom time, yes, a lot of all these companies, eBay, all these are moving up higher, okay? But during that time, if let's say 1990 over time, in the 1990s, right? If YouTube came out, they are not going to be successful. Because why? Because the infrastructure is not ready yet. So that's why after that, YouTube came out and then they become a very successful things, okay, in the internet world. So same thing goes to right now, okay? We do see what happened here is that inflation is not hitting the target for based on the central bank. Let's say Federal Reserve is 2%, but it's still above 2% right now. But they still want to reduce the interest rate. Why? Because they want to boost the economy. But looking at this is not hitting the target, so which means that they are not going to reduce the interest rate so soon. So they want to make sure that economy is able to sustain, okay, in a growth rate, but at the same time they want to reduce the inflation, make sure that it's not like out of control. Okay, so that's why these are the things, the data that you can see. You know that okay, consumer spending is getting low, so which means that the central bank is going to do something to reduce it. So if let's say they reduce the interest rate, okay, they increase the interest rate, okay, to allow not letting them, okay, the economy boom so fast, so inflation is not going to move up fast, then we know that the market is going to crash a bit or maybe like correction. So right after that, when you start to see like the market, okay, everything back to the stable point, then you can start to move in again. Okay, so that is the spending, okay, on the inflation with the real earnings. Okay, then the next one we are going to look into it is the savings and interest rate also play a crucial role in consumer spending. So that's why the personal saving rate is another economic indicator that can be calculated from the disposable income. So if you look into this chart over here, we can see saving rates often saw during an economic recession. Okay, so you can see from here, 2008 time, okay, it surged up. Then 2020 time, when the pandemic comes in, the market actually crashed, right? During that time, then it started to move back up again. Then is the time saving rate increased again. So in early 2000, it increased again. Then right after that, when the market comes back to normal, then it goes down lower. Okay, so that's why we do see like people are not spending it so much. Why they are not spending it so much? Because recession. Maybe some of them got affected, got retrenched, got like fired from their company. Then they would think like, okay, I'm not going to spend so much. I need to save it in case, okay, I didn't get any job out from there. So once they get the job, things are coming in, people trying to boost the economy. Then we start to see like a lot of sales are coming out. Then you got a new job. Then that's where you start to think like, okay, I can spend a little bit more right now. So saving rate dropped right after the recession. Okay, so that's why since 1970, all this credit card has, that's the time the credit card actually start to foster. So the concept of anticipatory consumption, where consumer spend money on goods and services in anticipation of being able to pay for them in the future. So this shift towards like immediate gratification, where rather than saving up, for purchases, has been the factor in gradual decrease of the US personal saving rate, because they know that, okay, since I can spend now, then you can go into installment, why not, right? So that's why during periods when interest rate was very low, that time US is almost at a 0%, there has been a corresponding decrease in the saving rate, okay, which at one time reached a nadir of approximately just 1.4%. Why? Because interest rate is low. So people thinking like, okay, I'm not going to save the money, put the money in the bank because I'm not going to get anything out from there. That's the layman term. But on the other hand is that because you have credit card, you have loans, all this, so it becomes a shift. Instead of saving, you will rather use this future money to consume, to buy something. Because since you don't have to pay with the high interest, right, it's almost zero. So why not? I just use my future money, right, instead of putting my money in the bank account. But of course, this is different in Japan. Okay, Japan-wise, they're still saving money. People are not consuming because if you look into their history, the Japanese, they've gone through the economy where really ups and down, and also people, those generation, okay, that they gone through all this up and down. They know that, okay, things might happen, things might be bad. Like for example, every one of us, we've been through all this pandemic, right? So we know that, okay, pandemic is scary, okay, all this COVID-19 is scary. We do not know when is the next one coming in, right? So if let's say the next one happen again, we need to save some money, or we to prepare for this, right? So that's why people are, if you've been through all this like bad experience, you will tend to save more out from there. So, but then, in this case, we know, okay, in all those Western countries, they don't care about COVID. They think that all these are just conspiracy theory. So the government is making people afraid, all right? So that's why in Western side, during pandemic time is not that bad, okay? But most of the time, the saving rates can be influenced by the wealth effect also. So that's where we can see like there's a bit of changes after the pandemic, okay? So people are spending also at home, still getting all those, claims, okay? Or maybe the money from the government that support, right? So this thing actually changed. So come back to this saving rate is that which of these posits that as an individual wealth increase, whether through higher income or maybe appreciation of the asset, they feel more financially secure and they actually want to spend more, okay? So that's why this increase in spending is not, okay, does not preclude them from also saving more, especially if their disposable income grows substantially. So if you can see like people who suddenly just sell a property, they get a lot of money, if they have no self-discipline, they will just spend, okay? They will not just invest into other things. So that's why interest rate plays a very key role in financial decision, okay, making. So higher interest rate makes saving more appealing due to potential of earning interest, while lower rates makes borrowing more attractive and can spur spending, particularly on large purchases. Like during recession, Federal Reserve, usually what they do, cut their interest rate, okay, short-term interest rate, to boost the spending on interest-sensitive purchases, which can help to stimulate the economy. So that's why interest rate, okay, not just help to boost your spending, is also, if it goes down, okay, if you need to pay lesser interest, which means that you have more money in hand. So when you have more money in hand, then you can spend, okay? So these are the idea. You can see how central bank use a very simple tool, just interest rate, that can affect the whole economy and also consumer purchasing behavior, all right? So this is the consumer side, okay? Next one, we are going to talk about the PCE price index. So how these consumer indicators that investor can focus on, that can help you to make a better, investment for your retirement portfolio or maybe for education portfolio, okay? So thank you for joining in. I'll see you guys again in the next session.
Klever Stock, the ultimate financial insight for everyone.